You don't live under the stock market, you live under a rate. A market you never visit quietly sets that rate. The bond market. When that rate moves, your mortgage, job, and savings move with it. If your home payment is suddenly higher, the bond market is the first place to look. This video answers one question, and only one: no tips, no predictions. How does the bond market quietly control what you pay for life? Most people think rates are a central bank thing. That's incomplete. The bond market is where the cost of time gets priced every day. And once time has a price, every other price must adapt to it. Start simple. A bond is a promised money later, traded for money now. You lend today. You get paid back over time, plus a bit extra. That extra is the bond's yield, the return implied by its price. Here's the weird part. Bond prices and yields move opposite. If a bond's price rises, the same future payments look smaller today. If price falls, those same payments look bigger relative to today. So yields are not opinions. They're the market's math in disguise. Now zoom out. Governments borrow in bonds, so do big companies. That makes bond yields the economy's baseline price for borrowing. Think of it like gravity. You don't notice it until it changes. The most watched yields become reference points for other loans. Why? Because lenders need a starting price before adding risk. That's the first bridge. Bonds benchmark yields everyone's rates. Now the second bridge. Yields become discount rates for valuing assets. Discount rate sounds complex. It's just a translation tool. It answers, how much is a future dollar worth right now? The higher the discount rate, the smaller future money looks today. So when yields rise, the market demands a bigger haircut on the future. That's why stocks don't live alone. They live under the cost of money. But who moves yields? Here's the part that controls your life. Central banks steer very short-term rates like overnight money. That matters, but long-term yields are a different animal. Long-term yields reflect a negotiation about the future. Three forces drive that negotiation: inflation, policy, and uncertainty. Inflation is simple. If money buys less later, lenders demand more. Policy path means what rates might be next year and the year after. Uncertainty is the extra just-in-case compensation for long time. Term premium sounds technical. It's the price of not knowing. Put together, yields are the price of time plus the price of risk. Now the cascade. When yields rise, borrowing gets expensive everywhere. Mortgages. Home payments respond fast because they price off benchmarks. Even if your salary didn't change, your cost of shelter just did. Businesses feel it next. Loans cost more, so expansion gets delayed. That means fewer projects, fewer hires, and more pressure on budgets. Governments feel it too. Refinancing old debt becomes more painful. Higher interest costs crowds out choices, spending, taxes, priorities, and then stocks. Not because mood changed, but because math changed. A stock is a claim on future profits. Future profits live in time. If time gets more expensive, those distant profits get discounted harder. That's why growth stocks can drop hard when yields jump. It's not morality, it's duration. How far into the future the story is. Duration is just sensitivity to the cost of time. Nothing mystical. But here's the trap. People watch stocks and miss the cause upstream. The bond market often moves first because it prices tomorrow's risks. So panic in stocks can be an aftershock of a shift in the cost of money. And calm in stocks can be fragile if the bond market is still tense. This is why good news can still hurt markets when yields rise. Strong economy can mean tighter policy, higher yields, bigger discounting. Again, no villains. Just incentives, constraints, and time pricing. So what does the bond market control in your daily life, really? It controls the background rate that your entire financial life leans on. It controls which risks are rewarded and which dreams become expensive. And it controls how the future is valued by setting the price of waiting. The reframe is simple. Bonds are the economy's time machine. They convert the future into a number the present can trade. And when that number changes, the whole system must renegotiate reality. That's the quiet power, not predicting the future, pricing it. Which means the real question isn't, where will stocks go? The real question is, what is the market charging for time today? Because whoever can afford that price gets options. Others get squeezed. Next layer, who is forced to buy time and who gets paid to sell it?